Good morning. Well, we're starting week 7 now. Procurement solicitations. We're in the Chapter 19 of Kurtzner, and we're looking at paragraphs 19 through 19.7. In our case this week is a scheduling 11. We're going to get into procurement in context, and fundamentally, why do I care about procurement as a project manager? We got a purchasing department for that. Anything that is purchased is going to be charged to your project, and you're responsible for cost of purchasing. Deliveries. Lead time. If the supplier makes a delivery and your receiving inspection rejects it because it doesn't match the PO or there's something defective in the shipment, that's going to hit your schedule. If you buy some parts or subassemblies and they don't work, that's going to hit your project and hit your schedule. You are the customer and your supplier is your vendor, and you are part of the supply chain, and you need to be interested, you need to be involved, you need to be responsible, you need to be informed regarding the purchases and the procurement actions and activities for your project. Even if you don't buy any materials, even if you don't have any subcontractors, if you use temporary labor, if you use a consultant, if you bring in some outside technical service, you may think that all the T's and C's are negotiated, everything is done and all that, but you need to be aware of what is in the agreement between the two parties, because you're going to be supervising or assigning some individual to do work, and you really need to make sure you're getting what you're paying for, and you need to make sure that you're staying within the T's and C's of the contract and you're not going outside of them, or you could put your company in breach of the contract with your supplier. And we can ask the question, what experience do you already have? Well, I know you have experience buying things. I know you have experience working with vendors. I know you have experience in your own life buying things and being in transactions where goods and services go one way and cash or credit goes another way. And so that you're really involved there. Now that we got that established, let's move on and let's start talking about the actual procurement and actual involvement, especially when we're getting involved in subcontracts and competitive bidding and sole source and the issues that pertain to that. And we're going to talk about market-driven target costing, a little bit about profit, and then we're going to spend some time on cost uncertainty, which will work us up into compensation agreements, which is the contracts which get us into negotiations and phases of negotiation. And we'll continue to move forward until we get to special purposes and talk about some capital equipment. In market-driven target costing, we're really looking at the situation after we actually have some profit in there. When we're looking at cost-driven pricing, and that's exactly what we're looking at most of the time when we're doing our estimates on projects and we're building up a cost estimate, we're not addressing profit, and actually after we take our cost estimate of the project to management, they'll establish what the profit's going to be if this project is to be offered out as a proposal to some external customer. Cost-driven pricing, though, if we have a vendor coming to us and trying to solicit us or respond to a solicitation we've put out there, if they're using cost-driven pricing, that may work when there's no competition, because what that really means is, first of all, they're going to determine what it's going to cost to them, and then they're going to add a profit. If we turn that around and go to target costing, which is the market-driven aspect of it, price-driven costing, what we're looking at is we determine what the market will pay. Our vendor is looking at us and figuring out what will we pay, and then what they want to do is they want to make sure that they can plan the project, put the activity together, what it is we're asking them to do, machine shopping, making castings, producing parts, whatever, provide training, provide consulting services. They're going to try and put that together and put the caliber of resources in there that can still allow them to put a profit in there and still hit that price-driven costing, that target costing. So they're going to target a cost, and then they try to manage what their actual costs are so that they have room to make a profit and have a reasonable profit. And that's called market-driven target costing. And when we talk about profit, we hear a lot of individuals speaking about profit, and they think it's a bad word or a nasty word, or it's the curse of capitalism or something like that. Quite frankly, there isn't any one of us that doesn't want a profit. If we have monies in a savings account, if we were to buy savings bonds, if we're to buy federal treasury, just to leave our money in a credit union, we want interest paid. We want that money to earn something, and to us, that interest is profit. If we say, okay, we have a certain amount of money, we want to invest it in a company, buy stock, equity in a company, we expect that company to run a business profitably so that some of that profit can be paid out in dividends, which is our return on investment, which is the interest, you might say, on our money being tied up in that company. In addition, it is from profit that a portion of the profit is plowed back into the company, which funds research and development, which funds the improvement and the raising of technology, the ability of that company to develop more products and services to stay in business. Just like you and I would pull our money out of a bank if they weren't going to give us any profit. And as a matter of fact, on savings account, it's very small right now, the interest that they're paying to us. Just like profit to a company, if a company, a supplier, makes reasonable profit, just fair and reasonable, not exorbitant profit, but fair and reasonable profit, and enough profit that they can return something to their investors, and their investors are happy, and they have something they can plow back in the company so that they can continue the development and the growth of the company, which is creating jobs, then they're going to be fine with that. Some of the items that actually helps profit and develop profit and good supplier relations is to have quality products and services, to have schedule compliance. If they say they're going to deliver something, we negotiate and they're going to deliver something at a certain time. If they meet it, they're able to hit that delivery. We're able to count on them. Our projects, our need for those products and services that they're providing are delivered on time so that we can stay on time and we can satisfy our customer, whether it's internal or external. Then there's also a reward for risk. Normally, the government, the federal government, if you're doing defense business with the federal government, if it's a high-risk contract, such as developing a new aircraft with advanced technology or developing a new high-speed computer for the government, that's high risk. And so there's a reward for that, and the government will allow us to have a higher profit percentage. If there is no risk for us, such as cost plus contract, a time and materials contract, cost reimbursable contract, where the customer is paying for all our costs and we have no risk, no liability, no matter how long it takes or how much it costs, they're going to pay for it. Well, then they're going to allow us a much lower profit. And then we're getting down in the 5 to 7% range for profits. And that's because there's no risk there. Also, if they're providing technical assistance, helping us with like technology transfer so that we can get smart on what they're delivering to us. If they're efficient, often we give them incentives in the profit for being efficient and developing schedules that lead to deliveries that are early. If there are tough times in the industry or in the project or something of that nature, profit helps them to weather those tough times as well. So there's a lot of positive, reasonable, equitable motivation and justification for a reasonable profit. With that risk that's set up, there is uncertainty. Sometimes in our compensation agreements, which are really our contracts, there's cost responsibility. Who's responsible for the cost? If a vendor takes a fixed price contract, or if we take a fixed price contract, fundamentally that means that no matter what it costs, we got to spend the money because the customer isn't going to pay us anymore. It's fixed price. If it's a cost plus contract, the customer is paying for whatever it costs. They have what they call the completion responsibility, the responsibility to complete the contract, to complete the project. So these are just the profit levels, and I just spoke about those. Often there's a motivation to perform. There can be in a contract comments and clauses for award fees, where if the vendor, the supplier, performs well, or performs above average, they may earn an additional award, an additional fee, award fee. And so there is motivation for them to perform and put their best people on it. Also, there's some protection from financial loss due to unexpected costs in a contract issue. This is really where an uncertainty, you can have a fixed price contract and you estimate that it's going to take you $100,000 to do, and it takes you $200,000. Your contract was for $110,000. $100,000 for cost, 10% for profit, $110,000. It cost you $200,000. You just had a $90,000 loss, almost as much as the contract. And so uncertainty is a statistical phenomenon. There's an expected value, what we're going to get about that, and that's all goes into consideration when we're talking about what we think the cost is, what the should cost is, what the risk is. We have to consider the risk. The risk has got to be funded within that profit, and then there's got to be a profit. The company has got to still try and make a reasonable profit, even in the face of certain risk event impacts that might occur. Here's a really pretty good chart about cost uncertainty. If we look at the curve, the blue curve in the center, what we're saying is there's virtually no chance of a loss with low uncertainty. We have a line in the center, which is the expected cost, and the uncertainty is very narrow. There's not much uncertainty about it at all. We add a certain amount to that, which is the expected profit, and that brings us to that line on the right side there, right before we get into that red zone. And so with a low uncertainty of cost, in other words, we have very high confidence where the cost is and where the cost can be. We can be under or over, but the margin is very small. Then we have a low uncertainty of cost and we have a high certainty of expected profit. However, if we take a project like developing a new technology or going into a new material or something like that where there's a high degree of uncertainty, or we're looking to provide a software program or a computer that has a extreme performance capability or functionality which hasn't been produced before, and we want a very low false alarm rate, we want a very low error rate, very high producibility, then the expected cost, the tolerance around that widens out, and you see the red curve there, which says there's a lot of uncertainty about where the cost really is, and we still have that expected profit on there. If our cost starts to increase above the expected value, you can see we're going to be eating into that expected profit until we come to that point, say like that $110,000. That when we exceed that $110,000, then we have a high cost. We have a loss. We actually have a loss, and there's a high uncertainty for that loss. The fixed price is the expected cost plus the expected profit, and that's what we negotiate for around there. And what we'd like to do is make sure we have a low uncertainty regarding the cost, because if there is, then we have a high confidence level we'll make the profit. High risk project, high risk contract, we're going to have something like that red curve, and there's going to be a high likelihood, very high likelihood, that we're going to exceed both the expected cost plus the expected profit. And then at that point, the company has gone into a loss position and we are losing money. When we talk about our compensation agreements, which is really the terms of the profit and some of the terms and conditions within the contract, we're looking at that the uncertainty of cost is really a form of risk, and it needs to be taken into consideration when we're doing a contract, doing a project for an outside firm, or they're doing one for us. Normally what happens is the project manager, unless it's at a high level project manager, they're more involved in the cost, and management, if we're going to submit a proposal, is more involved in understanding the expected cost, understanding what our risk assessment is, what our risk reserve is, and then they try to determine how important it is for them to win this award, and then they'll set the profit accordingly, also taking into account the uncertainty. Is this a technology that's not proven? Is this got a lot of uncertainty to it? If it's an R&D type project, a new development, that is high risk, very much high risk. And so there'll be considerations for that, and there'll be some type of margin because they want to make sure that they don't really lose money if they can help it. An important point is that even though the uncertainty in cost, as we've been speaking about for the last few minutes, it also affects schedule as well. If we have a technical setback, that's going to increase both the cost and the schedule. Quite often, it's not necessarily a technical setback, but in our design, in how we put something together, in how we develop the software, in how we put servers together and wire them up and set up the gateways and all the switches and everything for it, what we find out is we need to confirm that we do have a valid system or everything is working properly, so we run tests. So if we're going to run tests, we anticipate that it takes a certain period of time to write the test process, the test plan, the test processes, set up the test conditions, and then run the tests. We expect it to pass. Often we'll do a certain analysis or a statistical analysis, and we'll say, all right, maybe we'll get an 80% pass rate or a 90% pass rate. But if your contract says you need a 100% pass rate, you could have some really setbacks by not being able to pass a test and having to rerun them, or discovering bugs and having to fix them. And then you have the time not only of rerunning the test, but you now have the downtime waiting for the team to find the bug and then fix the bug and then do all the testing, regression testing, and all the other testing it has to be done to make sure sure that the bug fix hasn't introduced any other bugs or anything else of that nature in there. So when we've got our price and we got our cost set and we've got our proposal written and we sit down and we're looking at the award, customers picked us or we've picked a vendor, then we sit down and do some fact finding and also get ready for negotiation. The objectives of the negotiation on both sides is to make sure that whatever it is, if we're selecting this vendor or they're selecting us, some customers selecting us, what we put together can meet the triple constraints of cost, schedule, and performance. And that in negotiation, we want to make sure that we can have a reasonable level of control over the contract performance and that we can do it in such a way we maintain long-term good relations as a supplier or with our suppliers. One of the hallmarks of really doing that is not go into a win-lose situation or I got you or I want leverage over you. The best way to do it is to go in showing respect and having integrity, having a level playing field. I call it a level playing field. What's good for you is good for me, and I want a good relationship. If we have a relationship where one party walks away from the table thinking they've been taken advantage of, it is going to be the seeds of adversity. It'll be the seeds of a relationship that deteriorates over time, and that is not really a good place to be. Not if you're going to have a long-term situation, a long-term relationship. And if what you're as a supplier or negotiating with a supplier, then if you have long-term maintenance and upkeep requirements, either for you delivering to a customer or for whatever it is you're buying from your supplier, you want that relationship to go on a long time, and you want there to be that maintenance, a sustaining support relationship that's always done on equitable terms. And when the phone rings, it's answered. And when service is required, it's given. This is what we want to try and get out of negotiation. Now, it says that negotiation is preferred when competitive bid is not appropriate. This is, of course, true, because if you're going to a directed procurement, sole source procurement, where you really only have one supplier or you are one supplier, negotiation is really important, because what you want to do is to make sure that you're not being taken advantage of or not taking advantage of somebody else. And so you usually go on negotiation. So it is really preferred. But quite frankly, even in competitive bids, negotiation is required also in most cases. And the reason is because even though you got multiple bids and multiple bidders from a competitive bid, negotiation is done to make sure there's not fault in the agreements, there's not a mistake or an error, and to make sure that you have a competent supplier that understands, or that you are a competent supplier that understands, and you're able to do the job, and the probability of meeting those triple constraints is very high. You really want to make sure that this is going to be a good relationship, and that the service and the products that are provided really are doing a very, very good job. When we prepare for the negotiations, one of the things that I've practiced, no matter what side of the negotiation I'm on, is that I always put together what I call my negotiating portfolio. And my negotiating portfolio has certain requirements in it and certain items. Number one is whoever is sitting across the table from me in negotiations, I want to make sure I understand what their needs are, exactly what they have to have, what they cannot do without, because that'll be the floor of various points in the negotiations. Also, as a negotiation individual, I've got to understand what I cannot give up. What are the items I must have out of a negotiation that I cannot do without? Because those areas, those items, those constraints are hard points in a negotiation, and you cannot go past them. Otherwise, you're going to have a problem, and you're not going to be able to complete the negotiations. You also want to make sure that you are able to defend and support your positions that you have put into your proposal or into your position when you're charging a proposal, when you are actually challenging the proposal. You need to understand the costing. You need to understand the elements in the proposal very, very well. You also need to understand what your corporate requirements are, your corporate position is, and you need to know the seller. You need to know both sides, the seller, and if you are the seller, you need to know the buyer. And it's got to be a good relationship, and this is part of the preparation. And preparation goes on from the time you submit your proposal till the time you find out you've either been awarded and negotiations are starting, or until you find out that somebody else got awarded and you're not going to win this one. So then you don't need to worry about any more preparation. Additionally, I usually have what I call a white hat, black hat session where I get certain very competent individuals in the company to sit as the opposite side of the negotiations and to prepare for them, take a week to prepare, 2 weeks to prepare, and then actually come together and negotiate. I want to see them tear our position apart or tear the position apart that I'm representing, because that'll tell me how well I'm prepared, how well I have prepared for the negotiations, how well I can substantiate the questions that'll come in me. I may not anticipate all the questions, so by having one of these type sessions, I get a chance to get under fire, so to speak. And usually your friends that are on the other side of the table will really try very, very hard to tear you apart. And often you learn that there are significant weaknesses in your position. We talk about bargaining strength, and quite often you've heard of bargaining strength when you've heard from the newscasters and on TV about maybe some union negotiations or some other negotiations between countries or things of that nature. And there are factors that favor the seller. If the seller's need for the contract is low, I'm going in here and I've bid on this contract, I want to win this contract, but it isn't the end of the world, it's not a must-have. That favors me because I don't have the same amount of pressure on me. When that my confidence is high that I'm going to attain the contract, that gives me confidence, that gives me good posture in the negotiation. If there are short lead times, it favors the seller because the buyer really may not have the freedom to start all over again with somebody else. Also, if there are information leaks from the buying firm, sometimes we find out what their positions are. People have a tendency to talk when they should, and if you learn information without doing anything illegal and it can favor the seller, there's nothing wrong with that. Also, if there is very little competition, or you might be the only seller that has the capability or the technology, that favors you. From the buyer's point of view, competition, many bidders, favors the buyers. If they have good cost or pricing data so that they can do very good analysis and ask very specific questions about the seller's costing structure, how they put together their price. Good preparations for the negotiations. In the negotiation skills are honed by doing practice negotiations like I just described. If we have good knowledge as the buyer, we have really gone to town on the seller's proposal and we really understand it and have taken it apart and looked into it, and we got very cogent questions about aspects of their proposal which might show weakness, or we want to find out if there is a weakness there, and the knowledge that we have of the seller's business. And the other aspect that favors the buyer, if we can do this in-house, as I spoke earlier, if we can do this in-house, then we may not be that desperate to make sure that we have a good deal here. When we get to go into face-to-face negotiations, usually in the front end there's some fact-finding. After you've been awarded, usually there's some questions and answers, and then usually there's a protocol that's established how the negotiation is going to go. You go through the negotiations, you sit down and you have sessions, and sometimes you can call 5 minutes or 10 minutes, 15 minutes or a half an hour, because you need to consult with your support, with the people that are provide support to you in the negotiations. If you are working on differences, you're trying to narrow them down, you're trying to find out what's behind the positions the opposite party is taking. And then often you get into hard bargaining. That's really a last resort. In really hard bargaining, that's often win-lose, and I really don't like to get there, because that's when you usually walk away from a table. Even if you've finally come together, you walk away, one side is going to think they lost, and they're going to have bad feelings about that, and there's going to be a resentment there that can really hurt the relationship long term. The government usually used to, I'm not familiar enough right now if they still do it, but there used to be that after everything was all done with the negotiations, they might negotiate with a couple of sellers. And by negotiating with them at the very end, then they ask for a best and final. In other words, no matter what you've said, what agreement we've reached, or anything else, what we're saying is give us your best and final offer. And what that usually is a challenge to reduce your price to significantly so that you're selected over whoever the other party is. And then there's also different collaborative, traditional versus collaborative approaches, different ways of doing the negotiations in that regard. Moving on from negotiations now, and we talk about some special purchasing when we're talking about purchasing of services. And services is really a growth area because we're doing an awful lot now with automation. We're doing a lot with computer, AI, artificial intelligence, things of that nature. And so services is becoming a greater growth area, and manufacturing or production is actually becoming less. When we're talking about purchasing of services as a special purchase, we want to make sure we've planned and documented the service statement of work. We have some critical steps in establishing what we're going to pay for, and that we have really a clear and detailed statement of work. That'll improve the performance of that supplier. Contract types, whether or not we're going to have cost plus or firm fixed price, depending on the risk, the motivation, terms and conditions in the contract. Every contract has T's and C's. When you get beyond the schedule, beyond the cost, when you get beyond the statement of work, the technical approach, the background on the company, when you get beyond their references and all that, you get down to the terms and conditions, which are things like termination, which are things like payment, which are things like warranty, intellectual property, things like that. There's a lot of fine print that has to be read and understood very, very well, and to find out whether it's a level playing field. Is it equally applied to both of us, or are you taking a favorable position based on what you're doing? And then property management is a typical example that you can consider. Oh, and one thing that we want to have in the contract is we want to have some discussion on how we're going to have the monitoring of performance, how we're going to manage the contract, what is going to be the relationship between the parties, will we be talking to each other, will our technical people talk to each other, what kind of reviews are we going to have of the performance of the seller. How are we going to make sure that we are dealing with payment? Maybe the contract or the seller requires a monthly payment. What are we going to pay them on? How are we going to know that what we're paying for is worthy and we're not just sending them money and not getting anything in response? There are legal issues. Depending on if we are having a service contract where we are bringing consultants in or bringing temporary labor in, and for how long a period of time. There was a lot of discussion about that with Microsoft and a few other companies a number of years ago when that became a very, very big issue. If you actually bring in temporary workers, but you're supervising them and basically assigning them tasks and telling them what to do, that's a classification of employee. And so you actually have to bring them on board and take out Social Security, pay Social Security, you've got withhold taxes, all of these kind of things. If they're contract workers will be for a shorter period of time. Usually it's less than a year, and also what happens is that there is less supervision. You ask them to come in and do a certain thing, but then you don't supervise them in the process of doing that. So there's a lot of legal issues when you start bringing in temporary labor. Another special purchase is capital equipment. And this is really significantly different from ordinary purchasing, because when we're buying capital equipment, there's a real question of whether the project pays for it or not, because capital equipment is a classification of equipment that is purchased by the company so that they can do business. It's a non-recurring purchasing. Price is usually high. Capital equipment could be a complete set of vehicles. A capital equipment could be machinery. It could be something, special air conditioning system, special pressurization system. Usually it has a long lifespan. That usually has an operating cost to it. There's tax implications. With capital equipment, if a company buys capital equipment, they get certain high percentage deductions off the taxes for the first year, and then they can go into depreciation. It becomes capitalized or amortized, not expensed. Capital equipment, normally projects do not buy capital equipment. The corporation has to buy capital equipment, so capital equipment should not be in the project budget. The project may require capital equipment to be purchased, but then the company has got to put that equipment in its budget for a capital equipment budget, and it has to pay for it because all the benefits, the financial benefits of amortization, expensing, everything else that is done with capital equipment normally falls to the corporation. And then the amortization cost and capitalization cost of capital equipment, actually an element of that goes into overhead, and then it is distributed across all the projects with a certain amount, depending on whatever the burden rate is or the overhead rate is for the costs of recovering all of that kind of activity. Capital equipment purchasing is usually a very formal process, and there has to be a justification for it because of the amount of dollars that are tied up into it. Finance gets involved. A lot of times we talk about return on investment, or how soon are we going to realize recovery from it, what kind of money is it going to make for us by using it. We do a lot of product comparisons. What kind of capital equipment are we going to buy? Who makes it? We talk about life cycle costs, net present value analysis, lots of financial analysis. Normally, upper management, and I mean really the executive management, must approve and purchase the actual capital equipment. And normally that's at the level the CFO has got to sign off on it, and so it is usually the COO or CEO got to sign off on it. And sometimes the amounts of monies are so large that the board of directors has to be involved in it as well. The project can initiate or drive the process because if the capital equipment is required to be able to perform on the project has an incentive to make sure that the company understands they have to buy the capital equipment. It's got to be separately budgeted in the capital equipment account, and if we win this project, then the company's got to spend that money and buy that capital equipment, or we will not be able to perform the project. The project's going to crash. And so purchasing has a role to play in all of this. They can help us with research, finding out companies, finding out the attributes of the capital equipment, potential sources, doing coordination, negotiations, fact-finding, drafting catalogs, and then all the administrative paperwork that has to be done. They can help and support us in those activities as well. There are other options rather than just buying brand new capital equipment. Often there is used equipment on the market at the lower prices, and also depending on the life and how, whether it's been abused or how long it's been used, the life, it may be at a reasonable price, and it may be viable investment to purchase some used equipment and use that. And that'll keep a lot of our costs down. It's immediately available. We can get it right now. Usually, though, there's problems with that. There's no warranty. It may be subject to repair. We ought to do a really good inspection on it. If we're not talking about new equipment or used equipment, often many companies will do leased equipment, or what they do is they work with a third party, and it's called lease buyback. What will happen is that the company will buy it. They'll be reimbursed by the third party, who will wind up owning the equipment and then leasing it to us, and then we pay lease costs on a monthly basis, and those lease costs then we're able to expense them, and so they immediately come off our taxes right away, and we don't have to go through amortization or anything like that. However, the lease cost is still going to be over a period of time of several years. It might be 5 years, 10 years, 15 years, depending on what the anticipated life of that equipment is. Those are the kind of situations, and when we get into capital equipment, whether we're getting new capital equipment, used, or a leased equipment, we are going to get involved with a lot of the executives of the firm. Some pros and cons yet on leased equipment. We can get services from the lessor, whoever owns the equipment and who's leasing it to us. Can be immediately available. The equipment there's flexibility. We can set it up so that we avoid obsolescence. It is good for cash flow because we're only going to pay a smaller, much smaller amount on a monthly cash flow basis, and rather than paying for the whole thing up front. It really affects our debt to income ratio. Our debt doesn't go up. We have a liability, but we don't have an actual debt per se. And then, as I said, I talked about tax implications. Um, some of the cons for leasing equipment is you got a long-term cost. You sign that lease and you're going to pay until that lease is over. And there's restrictions you have on it. You can't sell it, you can't modify it, and sometimes you have obligations to have a certain amount of maintenance and take care of it, and then there are other terms and conditions that might come into play on it also. So in addition to all these price considerations, quite often we do a lot of life cycle cost analysis. We want to say not only what is the upfront cost, the cost to own, the cost to acquire, but what about maintenance, repair costs, and downtime over time? What is that going to cost us? Is there calibration requirements? Are there materials and supplies? Do we got to change the oil every month? Do we have to put new tires on it? What about operator safety? What about special training? Does it require, if we're buying some really heavy equipment, does it require us to get with the power company and have new electrical energy, new power distribution brought in for us? What about insurance, depreciations, resale value? So in this, when we're doing life cycle cost analysis, what we normally do is we do a net present value over the expected life cycle, and we want to add in all the costs that this is going to cost us over its entire life cycle, and then bring those costs, which are out over time, back to today, which means we calculated net present value, and that'll tell us what this is worth today, so we can actually compare apples and apples on cost when we're doing that type of thing. An example in talking about purchasing construction services, there's several different ways that we can do it. The conventional way is, in other words, we sequentially do the construction. We'll go out and we will contract with an architect and get the architecture and design done, and then we'll contract with the various construction type bidders, plumbers, foundation, carpenters, electricians, landscapers, interior decorators. All of these things we'll do, having power brought in, getting the permits, all the things that we need to have, recycling systems that we have to have if we're going to get into construction, and we're doing a conventional construction where we're actually sequentially going out and letting contracts to the various different types of firms that we need to engage to provide us with that construction, with that building. And then we compare that conventional, where you do a design and build for a firm agreed price. In other words, you have a builder come in and actually bid on the whole thing, lock, stock, and barrel, and the possibility is that you could actually save about 25% over doing it the conventional way. And then moving on to design and build cost reimbursable. That means design and build phases overlap them to save time. Your cost is going to be more uncertain, but there's a 9% saving over conventional. And then using as a team, where a builder works with designers on cost schedule and different phases, design and build phases, they overlap to save time. That's still a 9% saving. And then if you, as the owner, function as the general contractor and then do everything yourself and have again still use phases, you most often can't save more than about 5%. This just gives you a comparison of some of the ways, if we were to look at construction services, how the different ways of contracting and working with the firms that we would need to actually do the work, what kind of potential savings we might experience. When we consider negotiations, we consider contracts, we consider procurement, we really need to consider the supplier relations as well. Quite often we will have several conferences with the bidders. We will have a initial notification where we're telling them that we're going to release an RFP for a certain time and basically what's in there. Then we release the RFP to qualified bidders, and then we have a period of time where they prepare their proposals and submit them. Then there's a period of time for evaluation by us and selection of the winning bidder, and then we go into fact finding and negotiations, and then finally award and contract signing. And the key element here in having contract award conferences is communicate, communicate, communicate. You really need to avoid the learning curve misunderstandings. We may have been wrestling or if we're the bidder, our potential customer has been wrestling with this project for some time, and they've got a lot more knowledge, maybe not well documented, but they got a lot more knowledge and information than the person who's being the bidder has. And so we really need to make sure that we do a very, very effective communications, set the proper expectations, and make sure we avoid any learning curve misunderstandings, because that's where the errors and the mistakes are made, and that's where people really have career limiting experiences downstream, and it also sets up bad relationships between the parties. We also want to have structured monitoring and control activities. How do we evaluate the supplier and rate them? How do we make sure they're well motivated? How do we work together to solve the problems? There's a certain amount of exposure we have that when we have a contractor come in, because they're going to realize certain things about our company, about the way we do business and things like that. So we really want a trusted supplier. And on the other end, when we're the supplier, then the same thing works, just in reverse. And also when the customer comes in, they're going to learn things out about us, and we want to make sure that we also at the same time take care of that as well. Let's move on now to talk a little bit about supplier quality control, because once we have really established the relationship, then we need to make sure that what we're doing, we have good quality control, or we are monitoring quality, monitoring their quality control system, and monitoring the product or the service they're delivering to us. Or if we're the supplier, then we will be monitored, and there will be impositions placed on us, hopefully equitable ones, where the customer will want to have certain audits and have certain visits where they can check on our supplier. So the importance of it really is determined by how much of the purchased product is gone there, percentage. If we're buying 40% of what we're going to deliver to our customer, well, then it's very significant. If it's only 2% or 1%, it's not as significant. When we have poor quality, okay, and when we get poor quality or deliver poor quality, there's going to be high costs associated with it, because there's rework, there's replacement, there's interruption to schedules, interruption to cost. So the costs go up, the schedules go up, the problems go up. And so there's a lot of interdependence between the buyers and the suppliers. And there's other factors that affect us from the buyer's organization. And this is a reference to Duran's Quality Control Handbook of 1988. When we talk about long run quality factors, what we're talking about is, making sure that we got the appropriate specifications for quality requirements. We want to make sure we're not being onerous and being too demanding. We want to make sure that it's appropriate for what we're getting and appropriate for what we need to do. And we want to make sure that the supplier's capabilities can do the job for the right quality and cost, and they understand the quality. And I'm sure the customer will come down on us and have the same expectations of us, and that we both, the customer and the supplier, needs to monitor the control of quality and the cost performance. And even if it's our project and we're the customer, we need to monitor and control not only the quality and cost performance of the suppliers, but our own project as well. We want to make sure that we really have a complete and appropriate set of specifications, and that requires really to have a good blend, a good mix of the design requirements, commercial purchasing considerations, production factors, marketing factors. There's a lot of things just beyond just a specification. Do they have an understanding of the form, fit, and function of what it is that we're providing for them and what it is that we're supplying to them? And it really needs to be well understood and well communicated back and forth between us. We need to make sure that in that supplier selection, supplier qualification, that we have an ability to actually select capable suppliers by many different ways: testing their product, analyzing their proposal, taking on-site survey teams, as well as asking them if they will give us some of their customers as a reference that we can contact them. These are all prior to the selection, and after, once we're in the negotiation or we're getting through the negotiations, then we got to see how good their control systems are for detecting defects, detection and prevention. Do they have a good prevention system? Are they using statistical process control for monitoring output? What kind of defects? If they're providing some of the software or
some of the things we're doing? How are they avoiding defects? How do they do testing? What is their quality control? Are they well motivated? Keeping our supplier motivated by having early supplier involvement and making sure there's good partnering with the supplier. And finally, one last slide that I want to talk about today is ISO 9000 series. ISO 9000 came to the U.S. back in the 90s. It had started out in Europe, and it was a requirement in Europe that any firm had to be ISO 9000 certified if they were going to sell products and services in Europe. And it came over to the United States by companies that were trying to do business in Europe, like General Electric, Motorola, Raytheon, and many other companies that were doing business overseas. They all of a sudden were almost threatened. They weren't threatened by Europe, but they were threatened by the sense that they had to get certified for ISO 9000 or they would no longer be able to sell over there or do business. And so ISO 9000 came to the United States through those companies, and now many companies in the United States insist on that they do business with companies that are ISO 9000 certified. I personally have had experience in getting a company ISO 9000 certified, and it was quite interesting. I'm not going to take the time now to talk about it. We've spent enough time on this, but ISO 9000 certification is an entrance criteria right now for the global market. We are in a global economy today, and maybe some certain companies aren't really in the global market, but they are certainly affected by the global market, by their suppliers and their customers that are involved in it. So all of us are connected in one way or another to that global market, and ISO 9000 certification is really significantly important to us. It is something you need to take into consideration as we go forward. Well, I want to thank you for working through this with me today and for what we've covered and what we've established. Wish you a good week as I look forward to your involvement. Thank you for your attention. Have a great week.